This is something that we have got to let clients know ASAP. If they purchase and close on a home after April 15th, it is very likely that they are going to pay a higher interest rate or pay additional fees. Let me explain what I mean. So, Fannie Mae and Freddie Mac, anyone who's doing conventional financing, they have made adjustments to what we call loan level price adjusters. And loan level price adjusters are simply risk factors that are added onto interest rates. So, for example, if you have a higher credit score, the risk factor of you defaulting is less. So, what that adds on for a risk factor is much less, and you will in turn have a lower interest rate. If you have a 680 credit score, your risk factor is higher, and therefore there's more adjustments added to your interest rate. So, going forward, they have made adjustments. And really, what's interesting is it feels like they've leveled out the playing field. The higher credit score people that used to get a benefit for that higher credit score, the benefit will be less and their interest rates will be a little bit higher. The people with a little bit lower credit scores, their credit scores will not, or excuse me, their interest rates will not be as high. So they've kind of leveled the playing field for credit scores a little bit. But in general, you should assume about a quarter to 3/8 of an additional interest rate or an additional 1% cost on doing a mortgage simply based on these adjusters. Now, if the interest rates go down, well, these will adjust accordingly. But it's still, if I compare an interest rate that I could give you today, if there was no market movement, with an interest rate that I could give you after April or at April 20th, about a quarter to 3/8 of a point difference potentially. That's big, and that's important for our clients to know. One of the other big adjusters that Fannie and Freddie are adding comes into regards with debt ratio. Before, we did not pay much attention to debt ratio because it did not affect the interest rate. Now there's a price adjuster for anyone that has a debt ratio over 40%. This is big. We went back and we looked at 1 year's worth of clients. 58% of our clients had debt ratios over 40. So this is going to affect a lot of people. So one area that it might affect is when we are asking for documentation or when we are looking at income, sometimes we will say, oh, we don't need that. We're not using that bonus income. You qualify for what you want, and we don't need to document that additional income. Well, now, if it affects your interest rate, we are going to go ahead and document that because it could mean savings on that interest rate for our client. So that is one big change that we are going to start messaging to our clients right away. So the most important thing is that we are talking to clients about this window of time. And yes, fingers crossed, interest rates will come down. We've definitely had a spike up the last week and a half. But I do see that settling down as we continue to go into the spring market. But that being said, even with those adjustments down, the cost still could be a little bit more expensive because of these loan level price adjustments. So if you have questions on any of this or clients that want to say, here's what it looks like before April 15th, here's what it looks like after, let us know. We're happy to walk through that with any client at this point. Thanks for watching.